Welcome back to Investing Talk Podcast.
Today we're looking at energy fuels.
As usual, before we start, subscribe, like, and comment to this video to support the show.
It really does help us out.
And, today's company, it's not just about digging rocks out of the ground, is it?
No, not at all. We are looking at a company sitting at what I would call a critical inflection point.
An inflection point. That's a bold way to start. Miners are usually a slow burn.
Usually. But listen to this. This is the contrast that defines the whole story. Energy Fuels just posted a quarter with, get this, plus 337.3% year-over-year revenue growth.
Wait, say that again? 337%.
337.
Yeah.
And a nearly 80% revenue surprise on top of that.
And a mining stock. That sounds like a tech IPO.
It really does. But that's not even the real story. The real story is what I'm calling a dual commodity moat. We're not just talking uranium, we're talking rare earth elements, or REEs, plus some huge geopolitical tailwinds coming out of Kazakhstan and, the U.S. government.
All right, 300% grabs the headline, I'll give you that. But you know me, I need to see the stability behind the hype.
Yeah.
So let's get into the fundamentals.
Let's do.
You said that last quarter's revenue was $17.71 million.
Mm-hmm. That was the number that crushed expectations.
Right. But, and here's the but I can't shake, I'm looking at the projections for the current fiscal year, FY 2026.
I had a feeling you'd spot that.
Well, it's hard to miss. Revenue is projected to dip to $56.03 million.
Yep.
That's a 28.3% decline. So, huge quarter. But now we're staring down a contraction year. Why jump in now?
It's a classic trap if you only look at 1 year. FY 2026 is what I call a loading phase.
A loading phase. What does that mean?
Think of it like a farmer. They just sold their entire harvest at peak prices. That was the big revenue number. Now the barn is empty. So this year, it's planting season.
Yep.
They aren't selling, they're spending, rebuilding the stockpile, getting ore out of the ground at their mines. They're basically loading the cannon for 2027.
All right, so 2026 is the planting season. That makes sense operationally, but it's a painful thing for an investor to watch. What does the harvest in 2027 look like?
The harvest is massive. Next fiscal year, revenue is projected to hit $96.07 million.
Wow.
That's a 71.4% jump. So you go from a dip straight into a huge launch.
That's a serious swing. But revenue is one thing, profit is another.
Mm-hmm.
Right now, on a GAAP basis, they're burning cash. The EPS consensus for this year is negative 34 cents.
True. But again, look at the inflection. For FY 2027, that EPS flips positive to 14 cents a share.
So profitability is right around the corner.
Exactly. And here's the stat that should really grab you. The estimate revisions.
Like this. It tells you if analysts are finally waking up. What's the trend?
In just the last 30 days, analysts have shifted their FY 2027 estimates up by 290.5%.
290?
Yes. That is a massive leading indicator. It means the smart money sees something coming that the market hasn't fully priced in yet.
A revision that big is staggering. It suggests a fundamental change. Which brings us back to that moat you mentioned.
Yeah.
What makes this so different?
It's the processing capability. Specifically, the White Mesa Mill in Utah.
I've heard of this.
It is the only licensed operating conventional uranium mill in the United States.
The only one.
The only one. So if you're mining conventional uranium ore in the U.S., White Mesa is basically the only game in town. It's a strategic bottleneck.
So they control the choke point. That is a real moat.
It is. And they're using that mill not just for uranium, but now for rare earths. They're moving aggressively there. They just acquired Australian Strategic Materials to really capture that REE upside.
And that diversification is pretty important, especially with the macro picture right now.
Oh, it's huge.
Yeah.
Because you have Kazakhstan, the world's biggest uranium producer.
Like 40% of the global supply, right?
Exactly. And they're signaling trouble. They've warned their output is peaking, maybe even missing targets because of supply shortages for their own process.
So a slow motion supply shock.
That's the perfect way to put it. And at the same time, here in the U.S., you have the government pushing what they call Project Vault.
Right. I've seen that name. What is that exactly?
It's a $12 billion critical mineral stockpile. The government has realized it's dangerously dependent on adversaries for this stuff. So they are now a guaranteed buyer with a $12 billion checkbook.
And Energy Fuels is sitting right there with the only mill.
Ready to process and sell directly into the strategic reserve. It puts a floor under the price for them.
Okay, the fundamental story. It holds water, I can see the argument.
Hmm.
But a good story doesn't mean the stock is a good buy right now. So let's pivot to the technicals. How is the market treating this?
The market is absolutely waking up to it. The momentum is undeniable. Over the past month, the stock is up 16.9%.
Which is impressive, but what's the context? Is
Yeah.
the whole sector up?
The sector is yes, but look at the broader market. The S&P 500 is basically flat, maybe down a tiny bit, so
Yeah.
this is showing huge relative strength.
Okay, so it's a leader in a leading group.
Right.
But let's talk price levels, because that's where I get nervous.
Yeah.
It's trading around 2174, 2176.
Right near the highs, all-time highs.
Exactly. And buying at the absolute top of a vertical move like this,
Mm-hmm.
it just feels like you're asking for trouble. It's vertigo. You're fighting all that psychological resistance.
I get that fear, I really do. Nobody wants to buy the exact top, but this isn't a hollow breakout. It's backed by serious volume and institutional upgrades.
So the big funds are buying, not selling at these highs.
It looks that way, which, is a perfect segue into sentiment. Who's actually behind this move?
Let's talk about it.
The biggest name, the one that really moved the needle, is Goldman Sachs.
Okay, that's a name that gets attention.
On February 4th, they initiated coverage with a buy rating. That's Tier 1 validation.
But why now? What's Goldman's angle on a uranium miner?
It's an AI play.
An AI play. How?
Think about all those new data centers. They are absolute energy hogs. They need 247 baseload power that renewables, just can't provide reliably.
So they need nuclear.
They need nuclear. Goldman sees this not just as a miner, but as a critical infrastructure play for the entire AI boom. They're pricing in a nuclear renaissance.
That puts a very different spin on it. So it's not a dusty old miner. It's a tech energy play.
That's the narrative. And the consensus backs it up. 80% of analysts rate it a strong buy. And get this, 0 sell ratings, not 1.
That is rare. But what about price targets? If we're trading at 2174 and the average target is, well, it's also 2174.
I see where you're going with that.
It kind of implies the easy money has already been made, doesn't it?
Yeah.
Why am I buying today if the average target is right where we are?
Because that average includes old models that haven't caught up yet. You have to look at the upside optionality. Goldman's target is $28.35.
Okay, that's some room.
And the high target on the street is $33. Yeah. That offers you 30 to 50% upside from here. That's the real potential.
All right, you've painted a pretty compelling picture. The growth, the mill, Goldman, the AI angle.
Mm-hmm.
It sounds great, but it's my job to worry. So let's flip this around and talk about the bear case. What could go wrong here?
Hit me with it. I'm ready.
Okay, first up, valuation. The stock has a valuation grade of F.
Woof.
Yeah, an F. You're paying a huge premium for that future growth. If anything hiccups, that multiple is going to compress hard.
That's a fair point. It is expensive.
Second, and this is the one that really gives me pause, the divergence. While Goldman is bullish, MarketBeat's consensus target is $12.06.
$12. Wow.
That's nearly 44% downside from here. I mean, someone is spectacularly wrong. Either we're going to 30 or we're crashing to 12.
That is a scary divergence, I'll admit it.
And finally, there's the trough here itself. We know revenue is declining this year. We know EPS is negative.
Mm-hmm.
The loading phase. Right. But markets hate waiting. What if uranium prices wobble? What if that inflection gets delayed by a couple of quarters? You're stuck holding an unprofitable company. That's dead money for a year, maybe longer.
Those are all valid risks. I won't dismiss them. The valuation is high, the weight is real, the divergence is scary. But here's my rebuttal.
I'm listening. Why isn't that $12 target terrifying?
Because it's stale. It's almost certainly from analysts who haven't updated their models since that massive Q4 revenue beat.
So you think they're just behind the curve?
Completely. The market is pricing in the new reality. That's where we're at 21, not 12.
Mm-hmm.
And that F for valuation. You don't get a company with a unique strategic asset growing 70% next year for a bargain price. You pay up for that kind of quality and growth.
And the risk of it being dead money.
The market looks forward, right? 6 to 9 months, people are buying 2027 performance today. If you wait until the good news actually hits the P&L, you'll have missed most of the move. You have to buy the trough to sell the peak.
Buy the trough to sell the peak. It's classic advice, but it's hard to do.
That's why we do the research.
All right. We've hit the fundamentals, the charts, the sentiment, and the very real risks. It's time to make a call. What's the verdict?
I'm ready. I'm giving this an 8.2 out of 10.
8.2. That's a high conviction score.
It is, because this is a classic transition story. You're moving from trough earnings to a massive inflection. The drivers are structural, not temporary. You have the supply deficit from Kazakhstan, policy support from Project Vault, and now institutional validation from Wall Street linking it to AI.
So for someone listening, what's a trading strategy here?
It's a swing trade. Think 6 to 12 months to let this story play out. For an entry, 2174 is. It's okay for a starter position if you just have to get in.
But not ideal.
Not ideal. Ideally, you want to be disciplined. Look for a pullback to the $19 or $20 level. That's a key support area. That's where you want to scale in.
And the target's on the upside.
Base case is $26 to $28. The bull case, if everything goes right and uranium prices really move, could be 33.
So a potential run to 33 backed by a unique asset and a global shortage. It's a compelling story, even with the risks.
It's one of the most interesting setups in the market right now.
Oh, that's the verdict on energy fuels.
Don't forget to subscribe, like, and comment to support the show. We'd love to hear if you're buying this one or if that F grade on valuation is just too scary.
Thanks for listening, and we'll see you in the next one.